You just witnessed one of the most brutal institutional liquidation traps in precious metals history. If you woke up this morning, saw silver crash from over $90 down to 86, saw gold plummet from 54.94 down near 5,000, and you panic sold your physical stack thinking the bull market was over, you just got absolutely destroyed by a Wall Street margin call shakeout. This was not a fundamental crash. This was not a loss of value in precious metals. This was a mechanical market failure caused by highly leveraged hedge funds getting obliterated on their stock portfolios and being forced to dump their winning gold and silver positions just to raise cash to meet margin requirements. And while retail was panic selling at the $86 bottom, while weak hands were surrendering their physical ounces back to dealers at the worst possible price, silver just staged a massive V-shaped recovery, jumping 3.9% intraday to break past $90 again. The shakeout is over. The margin call liquidation is drying up. And the real war-driven rally to $94 and $100 has begun. The suits want me to tell you this is not financial advice, and they are absolutely right. This is not financial advice. This is a post-mortem analysis of a liquidity crisis that just separated the people who understand market mechanics from the people who trade on emotion and fear. Let me know in the comments below because I need to hear from this community right now. Did you get shaken out of your position during the $86 paper dump this morning? Did you see silver crater and decide the bull run was over and sell your physical metal back to your dealer? Or did you understand exactly what was happening, recognize this as a margin call liquidation event, and buy the dip before the $90 breakout? Because the difference between those two reactions is the difference between getting financially slaughtered by institutional algorithms and positioning yourself to catch the next leg up to $100. Drop a comment right now. Tell me if you held the line or if you got trapped by the fake crash. Your answer is going to tell me how well this community understands the difference between mechanical liquidation and fundamental value loss. Now let me break down exactly what happened today, because this is critically important, and if you do not understand the mechanics of why precious metals drop during a stock market crash, you're going to keep making the same mistake over and over again. Global markets are in a state of absolute panic right now over World War III fears. The United States, Israel, and Iran are in a full-blown military escalation. The Strait of Hormuz is facing a de facto closure. Iranian forces are threatening to shut down the single most important oil choke point on the planet. 20% of the world's oil supply flows through that strait, and right now it is a war zone. Oil prices are skyrocketing. Crude just spiked to levels we have not seen in years. This energy shock, this geopolitical crisis, just caused the Dow Jones Industrial Average to abruptly plummet by 1,200 points today. That is not a normal market move. That is panic. That is institutional money running for the exits. That is algorithms detecting risk and liquidating everything. When the stock market crashes like that, when you see the Dow down 1,200 points in a single session, the first thing that happens is margin calls. Let me explain what a margin call is for people who do not trade on leverage. When you are a hedge fund, when you are managing billions of dollars, you do not just buy stocks with cash. You borrow money to amplify your returns. This is called leverage. You might put up $1 billion of your own capital, borrow $4 billion from your broker, and control $5 billion worth of stocks. When the market is going up, this is fantastic. You make 5 times the return you would have made with just your own capital. But when the market crashes, when your $5 billion portfolio suddenly becomes a $4 billion portfolio, your broker looks at your account and realizes that the collateral backing the loan just evaporated. Your broker does not care about your thesis. Your broker does not care that you think the market will recover. Your broker cares about getting their money back. So they issue a margin call. They say you have 24 hours to deposit more cash into your account to cover the losses, or we are liquidating your positions. Now here's where it gets really important for precious metals. These highly leveraged hedge funds are not just holding stocks. They are holding a diversified portfolio. And for the last year, one of the best performing assets in their portfolio has been gold and silver futures contracts. Gold has been on an absolute tear. Silver has been on an absolute tear. These funds bought gold at 2,500. They bought silver at 70 or 75. And they've been riding this geopolitical safe haven rally all the way up. So when the stock market crashes today, when the Dow drops 1,200 points and their broker issues a margin call demanding cash immediately, what do these funds do? They cannot sell their stocks because their stocks are already crashing. If they try to sell their losing stock positions, they are going to get terrible fills and lock in catastrophic losses. So instead, they sell their winners. They sell the assets that are still liquid, still profitable, still trading with tight spreads. They sell their gold futures. They sell their silver futures, not because they think gold and silver are going to go down, not because the fundamental thesis for precious metals has changed, but because they are broke and they need cash right now to meet their margin requirements. This is a mechanical liquidation event. This is forced selling. This is what happens when leverage blows up and counterparty risk cascades through the financial system. And because these funds are all using the same risk models, because they are all getting margin calls at the same time, because they are all trying to sell the same liquid assets at the same time, you get a flash crash. You get gold dropping from 54.94 to near 5,000 in a matter of hours.
You get silver crashing from over 90 down to 86. And if you do not understand what is happening, if you just see the price dropping and you panic, you sell your physical metal at the absolute worst possible moment right into the teeth of the institutional liquidation. But here's the thing. Margin call liquidations are temporary. They are violent, they are painful, they create massive intraday volatility. But they do not last because the selling is not driven by fundamentals. The selling is driven by cash needs. Once the hedge funds raise enough cash to meet their margin requirements, the selling stops. The liquidation dries up, and then the market looks around and realizes that nothing fundamental has changed. In fact, the fundamental case for precious metals is stronger than ever because we are literally in the early stages of World War III. The Strait of Hormuz is closing. Oil is spiking. Geopolitical risk is at multi-decade highs. Sovereign debt is exploding. Central banks are going to have to print trillions of dollars to finance this conflict. Every single fundamental driver that has been pushing gold and silver higher for the last year just got amplified by today's events. So what happens after the margin call liquidation stops? The market snaps back. And that is exactly what we just saw. Silver crashed to $86 during the panic. Retail sold at 86. Weak hands got shaken out at 86. And then silver turned around and rallied 3.9% intraday to break back above $90. That is a V-shaped recovery. That is the market telling you that the $86 price was fake. It was a liquidity-driven flash crash, not a fundamental repricing. The real price of silver in a world where World War III is breaking out, where the Strait of Hormuz is closing, where oil is spiking, where the Dow Jones just dropped 1,200 points, the real price of silver is not $86. The real price is 90, 94, 100, and higher. Let me show you why this is so obvious if you just step back and look at the macro picture. We are in March of 2026. The global geopolitical situation is deteriorating faster than anyone predicted. The United States is in a military confrontation with Iran. Israel is involved. The entire Middle East is a powder keg. The Strait of Hormuz, which is the most important energy choke point on the planet, is under active threat of closure. If that strait closes, if oil tankers cannot move through there safely, the global economy experiences an energy shock that makes the 1970s oil crisis look like a minor inconvenience. Oil prices are already spiking. Energy costs are already going vertical. Industrial production costs are exploding. Inflation is about to accelerate in a way that central banks cannot control because this is not demand-driven inflation. This is supply shock inflation caused by a war. In that environment, what happens to safe haven assets? They go up. Gold goes up. Silver goes up. Hard assets go up. People flee out of paper currencies that are being debased to finance war spending and into assets that cannot be printed. This is not theory. This is what happens in every single geopolitical crisis in history. During World War I, gold went up. During World War II, gold went up. During the Cold War, gold went up. During the Gulf War, gold went up. During every Middle East crisis for the last 50 years, gold and silver have spiked because people recognize that in a world of war and chaos and collapsing currencies, physical metal is the only safe haven. So when you see silver crash from 90 to 86 on the same day that World War III fears are spiking, on the same day that the Strait of Hormuz is closing, on the same day that oil is going vertical, you should immediately recognize that something is wrong with the price action. The price is not reflecting the fundamentals. The price is reflecting a temporary mechanical liquidation event. And if you understand that, if you can separate mechanical selling from fundamental selling, you do not panic. You do not sell. In fact, you do the opposite. You buy. You recognize that Wall Street just handed you a gift. They just gave you the opportunity to accumulate silver at $86 in the middle of a geopolitical crisis that should be pushing silver to 100. That is a mispricing. That is an opportunity. And the people who recognized it and bought the dip just made a massive amount of money in a matter of hours as silver rallied back to 90. I break down these complex margin call mechanics every single day so you do not get robbed by institutional algorithms during a global crisis. I track the futures positioning. I watch the open interest. I monitor the liquidation patterns. I cross-reference stock market volatility with precious metals price action. And I do this because I know that the vast majority of retail investors do not understand how leverage works, do not understand how margin calls work, and do not understand that precious metals can temporarily crash during a stock market panic even though the fundamental case for owning them is getting stronger. If this geopolitical analysis helps you hold the line today, if it keeps you from panic selling your physical metal at $86 right before the rally back to 90, then consider hitting that super thanks button below to support the channel. This is how I keep the lights on. This is how I justify spending 12 hours a day tracking these markets and breaking down the institutional mechanics for you. Now let me give you the action plan, because understanding what happened is only useful if you know what to do next. The margin call liquidation is already drying up. You can see it in the price action. Silver bottomed at 86 and immediately started recovering. It is now trading above 90. That is not random. That is not a coincidence. That is the institutional selling stopping and the fundamental buying taking over. The hedge funds that needed to raise cash have raised their cash. The margin calls have been met. The forced liquidation is over, and now the market is free to trade on fundamentals again. And the fundamentals are screaming that silver should be going higher. Look at the setup. World War III fears are at multi-decade highs. The Strait of Hormuz is facing closure. Oil prices are spiking. Energy costs are exploding. The Dow Jones just crashed 1,200 points, which means the Federal Reserve is going to have to respond with liquidity injections to stabilize the stock market. That means more money printing. That means more currency debasement. That means more inflation. And in that environment, hard assets are the only place to hide. Silver is not just a safe haven. Silver is an industrial metal that is required for solar panels, for electric vehicles, for 5G infrastructure, for AI data centers, for every single technological trend of the 2020s. And the supply is constrained. We have been running a supply deficit for 3 consecutive years. The mining industry cannot keep up with demand. And now, on top of the structural supply deficit, we have an energy shock that is going to make it even more expensive to mine, refine, and transport silver. The next targets for silver are clear. $94 is the first resistance level. Once we break 94, we are heading straight for 100. And once we break 100, there is no meaningful resistance until 120. This is not speculation. This is technical analysis combined with fundamental analysis in the context of a geopolitical crisis that is only going to get worse. Iran is not backing down. The United States is not backing down. Israel is not backing down. This conflict is going to escalate. The Strait of Hormuz is going to stay closed or at least heavily disrupted. Oil is going to stay elevated. Energy costs are going to stay elevated. And precious metals are going to continue their safe haven rally. The only question is whether you are positioned to benefit from it or whether you got shaken out at $86 during the margin call liquidation. The only defense in this environment is physical metal in your own hands. Not paper contracts. Not ETFs. Not mining stocks. Physical silver rounds. Physical silver bars. Physical gold coins stored outside the banking system, where no broker can liquidate them to meet a margin call, where no counterparty can default on you, where no government can confiscate them with a keystroke. This is what the smart money is doing right now. While retail is panicking and selling at 86, while weak hands are surrendering their physical ounces, the institutional players who understand the game are accumulating. They are using this temporary dip to add to their positions. They know that silver at $86 in the middle of World War III is one of the greatest mispricings in modern financial history. I am going to be tracking the Strait of Hormuz oil shock and the COMEX paper drain every single hour as we head into the end of the week. This situation is fluid. This situation is developing in real time. And the next 48 hours are going to be critical. If the Strait of Hormuz officially closes, if we get confirmation that oil tankers cannot move through that choke point, oil is going to spike to $100 or higher, and silver is going to blow through 94 and 100 like they are not even there. Make sure you are subscribed to this channel with the bell notification turned on, because when silver breaks 94, when we get the next major geopolitical development, I am going to be putting out emergency alerts immediately. This is not entertainment. This is not market commentary for the algorithm. This is real-time intelligence on the most important commodity trade of the decade. And you need to be positioned before the rest of the market wakes up to what is happening. Here is the bottom line. And this is the lesson that every successful trader and investor learns eventually. Wealth transfers happen during maximum fear. Wealth transfers happen when the market is crashing and everyone is panicking and the headlines are screaming that the world is ending. That is when assets get mispriced. That is when mechanical liquidations create opportunities. That is when the people who understand the difference between price and value make generational fortunes. Today was one of those days. Silver crashed to $86 not because silver lost value, but because leveraged hedge funds needed cash to meet margin calls on their collapsing stock portfolios. Retail panicked and sold at the bottom. Institutional players who understand the mechanics bought the dip. And now silver is back above 90 and heading toward 94 and 100. If you sold at 86, you just transferred your wealth to someone smarter than you. If you bought at 86, congratulations, you just positioned yourself for the next leg of the greatest precious metals bull market in modern history. If you held your physical metal and ignored the paper price volatility, you did exactly what you were supposed to do in a geopolitical crisis. You recognize that the paper markets are temporary noise and the physical reality is permanent value. I just posted my exact technical targets and the specific physical bullion I accumulated during this morning's $86 shakeout to my private community. I broke down the specific products I bought. I explained my allocation strategy. I showed the chart levels I am watching for the next breakout. I gave my timeline for when I expect silver to hit 94 and 100. If you want to see exactly how Thag Insider trades a geopolitical margin call, if you want access to the real-time Strait of Hormuz monitoring I am doing, if you want to be part of a community that understands market mechanics and does not panic sell during institutional liquidation events, click the join button below and become an insider member right now. The people who join today are going to have front row seats to the silver breakout to $100. Do not let Wall Street's margin call mechanics shake you out of the trade of the decade. The war is just beginning. The energy shock is just beginning. The safe haven rally is just beginning. Make sure you are holding physical metal when silver breaks triple digits. I will see you in the next video when we analyze the next phase of this geopolitical crisis and the precious metals response.